Everybody wants to know the break-even for Social Security. Should you claim it early at 62, wait till full retirement age at 67, or maybe delay it until 70 where you can collect the maximum benefit? Which one wins? And that question's fine, but it's the wrong question. The right question is, how does your claiming age interact with your tax situation in retirement? Because the answer to that question changes the math by a lot more than the break-even age ever will. So let me show you. There's a number that's buried in the Social Security Trustees report that has a lot of people spooked. It's that the trust fund, the one that pays the retirement benefits, is projected to run out of reserves by 2033. And under the current law, when that happens, benefits will cut automatically by 23%. So people are running the math and thinking, I'd rather claim something that's certain now at 62 than run the risk of it getting cut later. But here's the problem with that logic. Claiming at 62 when your full retirement age is 67 locks in a permanent 30% reduction. So every month for the rest of your life, you're getting 30% less of your benefit. So you're accepting a guaranteed 30% haircut to protect against a possible 23% haircut in the future. And that haircut that's possible is something that Congress has fixed before. The last major reform was in 1983, and the political cost of letting it actually happen is staggering. So you're almost certainly locking in more damage than what you were afraid of. But that's not even the most interesting part of this. I'm Wes, I run Vault Private Wealth, and this is the kind of analysis that we spend a lot of time doing with people in their late 50s and early 60s. And what surprises most of them isn't the claiming age math, it's what they find sitting underneath it. So here's what I want to cover. I want to go through what the break-even analysis actually shows. Then, I want to get into the tax issue that I'm willing to bet many people have not looked into before. And by the end of this, I'm going to show you the specific calculation that tells you whether your Social Security timing decision is actually optimized or whether you're making a move that creates more tax damage than the penalty that you thought you were avoiding. Okay, so the framework first because you need it before anything else. You can claim Social Security as early as 62. And at 62, if your full retirement age is 67, you're receiving 70% of what your benefit would have been. That's a 30% permanent reduction. At 67, you get a full 100%, and if you wait until 70, you collect 124%. That's because between full retirement age and age 70, the Social Security Administration gives you an 8% per year delayed retirement credit. It's just a simple 8%, it's not compounded, so it's 8% for each year that you delay, and that stacks up to be about 24% total bonus. Now, the conventional wisdom is to run a break-even analysis. The idea is if you claim early, you get more checks, but they're smaller. Than the person who waited, they'll eventually collect less checks, but a larger balance. And you run the math on this and you figure out what your lifetime total benefits will be and when that crossover point is. If you compare claiming at age 62 versus 70, the break-even happens roughly around age 82 to 83. And here's the thing. The average 65-year-old today has a better than 50% probability of reaching age 85. So statistically, waiting wins for most people on a pure lifetime dollar amount. Over 90% of Americans should be waiting until age 70 according to research, but less than 10% of them actually do. That gap is the entire story of Social Security planning. But, and this is where I really want to focus, that break-even analysis is only built in a vacuum. It doesn't account for taxes, it doesn't account for Medicare, it doesn't look at what happens to your portfolio during the waiting years, and it completely ignores what I think is probably one of the most underestimated planning levers that most people in their 60s actually have to access. So let me talk about the Social Security tax torpedo. There's a concept called Provisional Income. It's the number that the IRS uses to determine how much of your Social Security check is subject to federal income tax. The formula is your adjusted gross income plus any tax-exempt interest, including municipal bond interest, which surprises a lot of people, plus 50% of your annual Social Security benefit. If that provisional income number exceeds $34,000 for a single filer or $44,000 for a married couple filing jointly, up to 85% of your Social Security benefit becomes taxable. Now here's where it becomes a real problem. In the zone where your provisional income is pushing your Social Security into taxable territory, there's something strange that happens to your effective tax rate. Every dollar that you pull from a traditional IRA or 401k doesn't just create $1 of taxable income. It creates $1.85 of taxable income. It's because that extra dollar of income increases your AGI, which increases your provisional income and then triggers another 85% of taxes on your Social Security benefit. That $1 ends up being $1.85. In the 12% federal bracket where most moderate income retirees live, your effective marginal rate on that extra IRA dollar is 22.2%. So you're in the 12% federal bracket and you're paying as if you're in the 22% bracket. This is what's called a tax torpedo, which is the perfect name for it because it comes from under the surface. You don't see it until it hits you. And this connects directly to your claiming age in a way that most people never see until it's too late. Between the day you retire and the day you turn on Social Security, there's a planning window. It could be a few years, it could be up to a decade. But during that window, your taxable income is extremely low. You have no wages, no Social Security, no portfolio withdrawals. That's a once-in-a-lifetime opportunity to convert money from a traditional IRA into a Roth IRA at the lowest tax rates that you'll likely see for the rest of your life. And why does this matter? Because Roth distributions are completely invisible to the provisional income formula. A Roth withdrawal doesn't count towards AGI. It doesn't count towards tax-exempt interest. It doesn't add a single dollar to your provisional income. It doesn't trigger the torpedo. When you're 78 years old and you're pulling out of your accounts, the Roth bucket is one source that your income doesn't make your Social Security more taxable. The moment you claim Social Security, especially if it's early at age 62, you start feeding 50% of your Social Security benefit into that provisional income calculation. You're now competing for the same limited tax bracket space you need for efficient Roth conversions, and that window starts closing. So yes, you're getting income, but you may be paying more in taxes on everything else, and you're eliminating the ability to do the conversion work that would have saved you far more over the next 20 years. And just a quick pause, if this kind of layered retirement tax thinking is what you're looking for, then please hit the subscribe button. This is what this channel is all about. And then there's Medicare, because it gets worse. IRMAA, which stands for your income-related monthly adjustment amount, it's your surcharge on Medicare Part B and Part D premiums for people who have above certain income levels. And here's the deal that catches a lot of people off guard. IRMAA is determined by your income from 2 years ago. Your decisions today about how much to pull from your IRA and whether you should claim your Social Security, whether you should do a Roth conversion, they're setting your Medicare costs up for 2 years from now. IRMAA surcharges apply to each person, so if you're married, each individual. For married couples in the highest tiers, that's thousands of dollars more in additional Medicare costs. And if you're claiming Social Security and running large IRA withdrawals simultaneously, you may be building a Medicare problem 2 years into the future where you're focused on income today. These three things, Social Security, Roth conversions, and IRMAA management, are not separate decisions. Now, I've been talking mostly about what this means for you, but for anyone who's married, there's a layer to this that's even more consequential: the survivor benefit. When one spouse dies, the surviving spouse receives 100% of the higher earner's Social Security benefit. Whether that's their own or not, they take the higher earner's amount, which means the higher earner's claiming decision is not personal. It's a joint annuity decision that covers both lifetimes. Here's how it all plays out. The higher earner claims at 62. The benefit that they would have received at full retirement age is $3,500, but they just locked in that 30% haircut, and now they're collecting $2,450 a month. When they pass away, their healthier spouse could live another 25 or 30 years, and now they're only collecting $2,450 a month instead of $3,500 for the rest of their life. Over that lifespan, that works out to be over 6 figures, and that's before accounting for the COLA adjustments that grow every year. So the higher earner Social Security benefit in most married couples is functionally the household's longevity insurance policy. You want to maximize the payout on that policy, and you want the surviving spouse to have the largest income floor as possible because they're the ones who end up having to manage this all alone. So let me give you that calculation I promised. Pull up whatever your projected Social Security benefit will be at age 70. You can get this at ssa.gov. Then estimate your projected income in retirement. Whatever you'd pull from your IRAs or 401ks each year, pension income, dividends, interest if you're doing consulting work. add half of your Social Security benefit. That's your provisional income. If that number pushes you above $44,000 as a married couple or $34,000 as a single filer, you now have a tax torpedo problem. Specifically, you need to know how much of your retirement income could be Roth accounts, what doesn't count towards your provisional income, how much Roth conversions should you do before Social Security starts, and what's the IRMAA impact of your income decisions in years 1 and 2 of your retirement on your Medicare costs 2 years later. Whether your optimal claiming age is 62, 67, or 70, or somewhere in between, depends entirely on running this full picture. The break-even analysis is a start, but the tax analysis is where the real money is. And to give you some sense of scale, a Federal Reserve analysis found that waiting to claim Social Security until age 70 boosts lifetime discretionary spending by a median of $182,000 in today's dollars. That's a cumulative difference in Social Security checks. That's the impact on your actual spending power when you model the portfolio, tax, and income picture together. The number is that large because of what the delay enables on the tax side. What your specific situation looks like, that's something worth sitting down and working through carefully. Whether that's with us or with someone else, run the full model. The provisional income number, the Roth conversion capacity, the IRMAA exposure, the survivor benefit baseline. One integrated analysis, and it really makes a difference. Now, if you want to do that with us, you can find a link to schedule a complimentary consultation with us in the bio. We work with people who have complex retirement income situations and want to see the full picture model, not just the claiming bracket age or the break-evens. The Social Security timing decision seems simple on the surface. Claim early and get more checks, or wait and get bigger checks. Find your break-even and you're done. But underneath that is a tax architecture that nobody told us about, provisional income thresholds that are frozen, Medicare surcharges trailing your decisions by 2 years, Roth conversion windows that open and close based off of whether you turn on that income stream, and for most married couples, a survivor benefit that turns the higher income's claiming age into one of the most consequential insurance decisions either of them will ever make. That's the part worth understanding. And that's why most people who think that they've figured this out are usually only working with half of the equation. If retirement tax strategy, the stuff that really moves the needle, is what you want to see more of, then please subscribe. I post a new video every week, and I'll see you in the next one.